Hello, and welcome to Ipsy Dixit, a podcast on legal scholarship. I'm your host, Luce Nguyen, a college student and co-founder of the Oberlin Policy Research Institute, an undergraduate public policy research organization based at Oberlin College. My guest today is Jacqueline Lainez-Flanagan, visiting associate professor of law at American University Washington College of Law's Janet R. Spraggins Federal Tax Clinic, associate professor of law at the University of the District of Columbia David A. Clark School of Law, and founder and director of the Low Income Tax Clinic at the Clark School of Law. We will discuss her article, Holding U.S. Corporations Accountable Toward a Convergence of U.S. International Tax Policy and International Human Rights, in the Pepperdine Law Review. Welcome, Professor Lainez-Flanagan.
Thanks, Luce. Happy to be here.
So let's talk about why did you write this article and what's the main crux of your argument within the paper?
I wrote this article. It was a product of working with the late Gwen Skinner. She wrote a great deal in the area of international human rights law. And in looking at one of her papers, I said, well, you know what? The tax system has some interesting vehicles that you should look into that will, meet some of the objectives that you're seeking. So through that project, it basically turned into a full paper of my own.
So let's talk about international human rights constructs and how corporations play into that.
Sure thing. So insofar as the corporate structure and as far as U.S. international tax policies involved, corporations are able to set up subsidiaries abroad. So a U.S. corporation, for legitimate business reasons, may set up a corporation abroad, but also as a result of that, they may also be engaging in effective tax planning. And that's fine and important, but the sole focus of my paper, or one of the focus points, is the fact that corporations that do so are not only affording themselves of beneficial tax structures, but they may also benefit from decreased regulation and decreased corporate accountability.
So let's go on to that idea of corporate accountability, particularly on foreign corporations and the Alien Tort Claims Act. What's the particular accountability held there, and what's the recent jurisprudence around the Alien Tort Claims Act look like?
Yeah, so the Alien Tort Statute, Section 28, 1350 of the U.S. Code, is really antiquated. It's a 18th century principle, so it's as old as the Constitution. It was instituted by, or signed into law by former President Washington, and it essentially just says that it's one sentence, that non-U.S. citizens can file lawsuits in U.S. federal courts for violations of international law. And really, for decades, it's been used for basically to allow victims, survivors of, abuses, torture, crimes against humanity, genocide, to sue those responsible within the United States. So that's been really valuable. But recently, in the U.S. Supreme Court, in recent rulings, they have chipped away. A lot of international human rights scholars have felt that the court is really chipping away at some of these protections.
So can you expand on that a little bit, particularly in the cases, in the Keyable cases, the Daimler cases, and the Jesno case?
Surely. In 2013, that was a Supreme Court decision where the court basically decided that there was a presumption against extraterritoriality in international law claims brought under the Alien Tort Statute. And essentially they said, well, this case does not touch and concern the U.S. Enough to bring a claim within the U.S. And the Keyable litigants, they successfully secured asylum in the U.S., but the court found that it was just too remote. The nexus was too remote to allow a case to proceed against Dutch Royal Shell for atrocities committed in Nigeria. And the 2014 Daimler Baumann case essentially underscored the jurisdictional limits of American courts to adjudicate claims against foreign corporations. And there the court cited 14th Amendment due process principles. And they said that the corporation needs to be at home in the jurisdiction that they're being sued. In 2018, in Jessner v. Arab Bank, the Supreme Court, according to many, was definitively foreclosing any finding of liability against foreign corporations under the ATS. So these cases have all served to basically chip away at what many believe to already be a shortage in remedies for people in countries where they really have no redress for wrongs committed outside the U.S. So the Alien Tort Statute essentially seems to be emerging as providing fewer protections than originally envisioned.
So within your paper, you suggest using the U.S. international tax regime to address some of these human rights issues. Can you talk a little bit about the bases of the U.S. international tax regime?
Sure. It doesn't seem, at first blush to be a perfect match, but in actuality, one of the basics of the U.S. tax regime and something that I really like to look to is Professor Yale. Well, he was at Yale for many years. He's at Columbia now, but Professor Michael Gratz said basically in looking at the normative analysis of the international tax system within the U.S., how the U.S. taxes international income, one of the bases is what is that normative analysis? What should it look like? So if you are a corporation operating within the U.S., you create a foreign subsidiary, how should that income be taxed? And he asked a really salient question, and one that I think is really at the heart of my paper, is whether a nation should be concerned with equity and economic well-being for the citizens of these foreign countries when creating these tax policies, or should they just attempt to maximize the well-being of its own citizens, regardless of the effect on foreigners? And that's really all a long way of saying that the U.S. system essentially says you can create a subsidiary, you can move income abroad, and we won't tax it. There's a lot of provisions, APB 23, I think, if I'm not conflating that rule, is one of the provisions that says if you think pretty sure that you are going to keep this money abroad indefinitely, then you don't have to declare it as income within the U.S. And then there's other vehicles like tax holidays, there's tax breaks that essentially ignore those provisions. So I think, it's accounting board principles. So there's a lot in the mix in U.S. international tax policy that favors corporate structures, that favors corporations in creating, in many instances, like legal fictions. There's inversions. We'll see the extent to which inversions continue to be used. They weren't used for a bit, and then there was a surge in them, and the U.S. tried to curtail them a little bit. But that's another example. And inversions are basically taking a U.S. corporation and creating a headquarters in a foreign land that's a lower tax jurisdiction for the tax savings. So there's a lot of different things, but at its core, the U.S. tax system is not doing enough to pull income from corporations. And in some cases, it's justified, and in some, it's not. And just one other thing that I really am always amazed by is when I look at the IRS tax data book, every year they report how much tax is collected from corporations, from individuals, from nonprofits. And for many years, it's hovered less than 10% of tax revenues are collected by corporate payors. And I think it was in the time of Eisenhower, it was like a third of U.S. Tax revenues were brought in by corporations. So clearly, the way the tax system is structured currently, it's to the benefit of corporations. And now you're compounding these tax benefits with this low corporate accountability. And so identifying that, I thought, you know what, it's a good time to write a paper about let's marry these two principles and not ignore that these realities exist.
So can you explain a little bit about what the foreign tax credit is and how it affects us?
Yes, the foreign tax credit, if you have established a subsidiary abroad, you can take credit for taxes that you've paid in a foreign jurisdiction. And that makes sense when you want to prevent double taxation. You don't want to pay taxes in the jurisdiction where the income is earned and in the jurisdiction where a company is headquartered. So that is all rational, but these foreign tax credits also, again, can be manipulated.
And can you talk a little bit about tax avoidance strategies? And particularly within your paper, you talk about the example of Apple Ireland.
Mm-hmm. Apple is a really interesting case study. I really like what the economist Joseph Stiglitz has said about Apple. He basically likens them as the premier example of firms cleverly using tax systems to avoid paying their fair share. And I'll talk a little bit about how Apple did that through Ireland. But the one point here as well that Professor Stiglitz says, they're avoiding paying their fair share by attributing income and profits to corporations that are stateless, right? They exist only in cyberspace, so they pay tax in no jurisdiction. And what he highlights is that companies like Apple have done this, and meanwhile their profits, right, their company corporate profits exist in part because basic investments by the U.S. government. The U.S. government created the internet, right? And obviously, so much of their business model and practices is dependent and reliant on that. And yet, in not paying taxes, they're not contributing to that infrastructure and to that development. So they take from the public, but don't give back, right? So in any event, Apple is a really interesting study for a number of reasons. They have been very visible. They are really, at their heart, an American company, despite using vehicles like Ireland. There are funny names that come out of these setups that they do. They have there's just so many funny names like the double Irish with the Dutch sandwich. But Apple and the Irish government essentially now have come to terms with a structure that involved 3 Apple subsidiaries. There was Apple Operations International, Apple Sales International, and Apple Operations Europe. And they were like Senate subcommittee hearings focus on their work and how they did it. But it's essentially, it was alleged that they received tax breaks by structuring their business with these 3 corporate, basically these 3 Apple subsidiaries. Apple is a U.S. company, and they essentially got what the Irish and what the European Commission, the EU Commission, ruled that Ireland gave Apple illegal state aid worth over 13 billion euros over a decade. And now Ireland has said, okay, we'll pay that back. But meanwhile, I think due to all this scrutiny as well, Apple has in early 2018 said that they would pay 38 billion in the US for its overseas holdings. And, some reports say that they have like almost 300 billion held abroad. But as you can see, this is also a good example of social political pressures on corporations. Like once, there's more scrutiny into transactions, there's oftentimes a resulting in higher accountability in the tax arena.
So when we're talking about scrutiny, and Apple in particular, in your paper, you bring up the idea of Apple shareholders mandating human rights assessments for Apple's supply chain. How will that?
Right. Yes. The role of activist shareholders is an interesting one because there absolutely is a role for the shareholders to play, but it's tempered a little bit by the SEC. It's also sometimes a minority group of shareholders, and there's even First Amendment principles that have been invoked in these scenarios where this minority group of activist shareholders want a certain human rights, assessment, risk assessment in a proxy statement, and the other shareholders may say, well, we don't necessarily adhere to this, and coupled with the inherent tension of the shareholder and the duty of the corporation to the shareholder, which is maximize profits. But again, I think we're entering an area where people are more aware of situations where corporate tax dodging is actually not just hurting, the fisc, the U.S. fisc, but also inflicting harm in nations where these organizations operate. So studying what Apple shareholders have done, there's no clear path forward. It seems that sometimes, for example, the SEC will rule there should be no action in this case because the ordinary business exception applies. And in other cases, like the Human Rights Index, they said, okay, that seems reasonable and doesn't encroach too much on the business rule that they often use. But on the net zero gas emission that some activist shareholders wanted to see in the proxy statement for Apple, the SEC recommended no action. And that happened really close in time. So shareholder activity is really interesting to watch. But at the same time, there's much greater vigilance, I would say, in the connection between human rights and taxation. And some, I would say, probably watchdog organizations are identifying that tax compliance and just how aggressive tax planning is in certain, corporate climates should be closely watched, and they should be held accountable for that. So all of that, I think, is a heartening direction to go in, especially when you take into account the fact that these judicial protections seem to be diminishing. So with that, if you want to look at it as an opportunity, with the decrease in these corporate accountability cycles as far as recent Supreme Court jurisprudence is concerned, saying we don't have jurisdiction to hear these claims because it doesn't touch and concern the land because of these 14th Amendment principles, and due process. And in other cases, they, have invoked, I should say, typical like international shoe principles that, are textbook early law school. And so it's interesting to see all of what the Supreme Court has done. And on the other end, there is a rising visibility of how corporations are structuring their business transactions and a rising concern internationally of how that affects foreign direct investment, how it affects individuals who are living in many cases, impoverished countries that are not getting the benefit of these tax revenues that are, in some cases, not being collected by any jurisdiction.
So how can international tax law promote human rights accountability?
In my work, I looked at the tax code and I studied what is available within the current infrastructure, because I think in large part, seeing if we can assist and really address this issue without reinventing the wheel. And there is a section of the Internal Revenue Code, Section 999. It deals with anti-boycott provisions insofar as countries that participate in anti-Israel boycotts. And that infrastructure is something that dovetails really nicely with the goal of implementing greater protections and really providing incentives. So in my paper, I talk about how Apple, for instance, if Code Section 999 was implemented to include an element of vigilance in international human rights risk assessments, supply chain investments in making sound supply chains. If that existed, that is one of the vehicles in which Apple can say, look, we adhere to this tenet, we follow it closely. International human rights and human rights writ large are important to us. So I think that perfect avenue exists, and I think this is just an introduction to explore that as a potential vehicle, particularly for U.S. corporations, because it has been very clear that the use of social media, raising awareness, raising visibility of these issues is something that is important. And when it comes to, movements, it is not within, or I should say it's definitely within the reach of the U.S. population if they found that a company like Apple, for example, if they breached in a really egregious way international human rights principles, that there would be ways to hold them accountable. And again, marrying the principle of tax and international human rights, it's actually a more natural fit than people may initially perceive, right?
So let's expand a little bit on Section 999 of the tax code and what the anti-deferral regime is and the impacts of the South African apartheid divestment movement is for today's international human rights advocates.
Yeah. The international human rights arena, this is not the first time so it's not really a case of first impression where the U.S. has, in fact, used anti-deferral regimes, or basically saying, we will not let you defer income if we find politically, right, that it's income that should be recognized by the U.S. due to an exception, a carve-out that we implement. So you're invoking the apartheid movement. There actually had been success in the past where in the prior application of this anti-deferral regime, or essentially foreign tax credits being denied to companies, meaning Congress, successfully got U.S. companies to divest because of this strong interest in opposing apartheid. And there are absolutely designated extreme risk human rights countries. So countries where there has been a recognized heightened risk of international or, and also local human rights violations. Sudan, Pakistan, DRC, Somalia, Myanmar, Yemen, and Nigeria are among those. And Myanmar, Coca-Cola, Chevron, they both operate subsidiaries in the country. In 2008, Chevron faced political pressure, and Congress considered revoking these U.S. tax deductions that Chevron was actually entitled to take as foreign tax credits because of payments that were made to a repressive military junta that was connected to a pipeline project in the region. And they ultimately, for other complex reasons, Senator Feinstein was pivotal in the decision not to prevent them from garnering these credits and not divest from the region, because she essentially said they're going to be replaced by something far worse. So what's the point in it? But ultimately, the vehicles that are available to the U.S. have been used before. So, it's like, it's possible, they can, but the political will is always the question. And that is, really another obstacle, right, to implementing something that absolutely is already there, that can be used. And by that, I mean Code Section 999, it's there, it's available to be used, and whether or not corporations will take advantage of it and should Congress choose to implement it is another story. But I think the importance is in identifying these issues and identifying that there are solutions, and at the same time, really providing another avenue for corporations who absolutely do have interests in maintaining sound corporate social responsibility standards, of providing them an outlet to do so, and to also overall acknowledge that tax and tax compliance absolutely overlaps with the international human rights movement. So that's an important recognition.
So another tool that can be used is mandatory reporting. And one of the examples you bring up in your paper is Treasury's mandatory requirement to report if a company is involved with the Israeli boycott, divestiture, and sanctions movement. How can that help the human rights campaigners here?
Yes. So the reporting requirement right now, and it's a pretty strict one because it has to be within like a 10% ownership interest currently. And then again, the level to which it's implemented right now is a different story. But in the human rights context, if there are corporations that are known violators, and by that I mean they contract, they have subcontractors, they have it's essentially the clean human rights record is what you want and what you strive for. And you want accountability. You want corporations to say, we want clean supply chains. We want to do business with local, because sometimes what happens essentially is that at the local level, right, there is corruption, there's bribery, there's situations that make the local workplace really oppressive for these, native workers. And so you want corporations to acknowledge, we check the records of our local contractors. We make sure that there's accountability. We make sure that there's, again, clean work areas, and there's a protection in place. And again, that there's redress. And that brings us back to U.S. Supreme Court jurisprudence, because if you have a local forum for redress of wrongs, then perhaps you don't need to use the U.S. as the forum to bring a claim. The big concern has been in these local jurisdictions, in these countries, these third world countries, where there is no appropriate method for redress. And if the U.S. is almost like the forum of last resort, that protectionist attitude of, well, we don't want to be, the U.S. should not be the world's courtroom. At the same time, the argument behind this corporate responsibility is that if you're in this foreign country and your subsidiaries take action, and in some cases there have been really massive atrocities, and if you do not want to have any part in that, then there's ways to make sure that doesn't happen. And again, having greater oversight, having greater accountability, and knowing, right, that the world is watching is one step to get us closer to that.
And so, big question, why does this all matter?
Yeah, I think for all of the reasons stated, that we want a robust global marketplace. We want an environment where there is foreign direct investment. We want corporations to be able to go in and revitalize economies. It's interesting that the amount of money, the 13 billion euros that the Ireland case involved, where Apple's paying that, Ireland is a pretty developed nation, but that 13 billion that Apple is paying would fund Irish healthcare for a year, right? And so when you think of places that are much less developed than Ireland, and you can imagine how much revenue corporations are foregoing, So I think connecting the two, connecting human rights and taxation is really logical. And I think also these opaque business practices in a rising global marketplace, we don't want to go in that direction. We want transparency. We want transparency in business practices, which includes, and in this human rights risk assessment, taxation should be a core element of that. I don't think it's really viable to separate the two any longer.
So for a final question, what should courts, companies, and regulators take away from your paper?
I think what should be taken away from the paper is a recognition of the possibility to move the dial forward, to not take away from necessarily, right, any foreign business dealings, to take away from even aggressive tax planning. But I think that the tipping point is where corporations are not paying taxes, corporations are not being held accountable for torts in foreign jurisdictions because of these increased corporate protections. So I think that my paper should be viewed as a whole on an argument toward being responsible corporate global citizens, and showing that, that we're all connected. We all have a stake in countries assisting the U.S. and assisting U.S. companies in generating revenue, but at the same time, these U.S. companies are also recognizing the importance of being careful, right, with the countries that they're operating within, and that they care about the livelihood and the health and ongoing, like the economic resurgence of these jurisdictions.
Well, thank you very much, Professor Lainez-Flanagan, for coming on the podcast to talk about your very interesting and intriguing work.
Thank you so much, Luce. I appreciate it.
I said to my Uncle Sam, "Old man taxes, here I am," and he was glad to see me. Mr. Small Fry, yes indeed, lower brackets, that my speed, and he was glad to see me. I paid my income tax today. I never felt so proud before to be right there with millions more who paid their income tax today. I'm squared up with the USA. You see those bombers in the sky, Rockefeller helped to build them, so did I. I paid my income tax today.
We paid our income tax today. We never cared what Congress spent, but now we watch your every cent, examine every bill they pay.
They'll have to let us have our say. I wrote the Treasury to go slow. Careful, Mr. Henry Jr., that's my dough.
I paid my income tax today.